Trade receivables, otherwise known as debtors, are the people that owe you money. They are the people that you've perhaps sold products to in the past and you've given trade credit to, which means that you'll accept a payment at a later date. This could be 5 days, a week, 10 days, 2 weeks, a month, 3 months, or even 6 months or more. Trade payables, on the other hand, otherwise known as creditors, are your suppliers. They are the people that have given you raw materials or indeed finished products to sell on. They have given you trade credit, on the other hand, which means that you owe them money. Is trade credit common? Well, if it's a business to customer transaction, it's fairly rare to find trade credit being offered. For example, you can't pop down to your local Primark, get a t-shirt and pay for it a month after. They wouldn't allow that. However, if it's a business to business transaction, it's much more common. In fact, many businesses who sell to other businesses will offer a significant amount of time for the other business to pay. 15 days, a month, a couple of months even. Whenever a business offers trade credit, they take the risk of not getting paid. Of course, you are essentially providing supplies or finished products to a customer who is buying from you and expecting that money to be repaid at a future date. Of course, there's several external factors which are outside of your control, which may mean that you don't get your money on time or if at all. For example, the other business may go bust in the meantime, and that will mean that you will not get your money back. Of course, not getting the money you owed in the long term can be devastating to a business, but even in the short term it can cause cash flow difficulties. So how can businesses incentivize prompt payment? Well, they can offer something called invoice discounting, which is when they might offer a discount for upfront or prompt payment. For example, pay us within 1 day and we'll give you a 5% discount on this invoice. Now, do all businesses pay on time? The short answer is no, they do not. This can be because of several factors. Potentially, they might be suffering from cash flow difficulties themselves, which means that they cannot pay you even if they wanted to. Of course, some businesses choose not to pay you on time. The reason for this is linked to Porter's 5 forces. In fact, one of the forces that Porter identified was the power of customers. And in some cases, businesses might sell to a particularly strong customer or a particularly persuasive customer, especially when they only sell to one customer, for example. That means that if they do not keep that customer on site, then they might lose a significant portion of their business. Therefore, that customer has a significant amount of power at their disposal and can say, no, we're not going to pay you on time. In fact, we're going to take longer and longer and longer to pay you. And that customer can do that indefinitely pretty much for every single contract that you make with them. That will of course mean that you do not get paid on time, but you're so reliant on that customer, you just have to accept it. Once again, how can you incentivize a customer to pay you sooner? Invoice discounting.